Hello and welcome to this edition of the Market Share. I'm Paul Gifford, Chief Investment Officer of First Source Bank. Joining me today is Rob Romano, our Director of Research. Rob, there's lots of investment topics to talk about right now, but let's get into talking about Russia and Ukraine and its impact on markets.
Yeah, we think the impact from Russia-Ukraine on corporate earnings will be minimal. The S&P gets about 2% of their revenue from that region. And on this graphic, you can see the companies that generate a larger share of their revenue from Russia-Ukraine. You know, we think the bigger impact is going to be felt, and already is being felt, within the commodities markets. And that means higher prices for consumers and also for businesses who use commodities and materials as inputs into their finished product. And on this graphic here, you can see commodities that are produced in Russia-Ukraine that represent a large share of the world's supply. As an example, you have aluminum. Russia generates 6% of the world's aluminum. Russia is also the third largest energy producer, exporting 5 million barrels per day. Russia produces 40% of the world's palladium, and Russia, Ukraine are large producers of agriculture commodities, specifically wheat and corn. And Ukraine is considered the breadbasket of Europe. So this means higher costs for consumers at the pump and at the grocery store. And for the Federal Reserve, it complicates an already difficult market environment.
So obviously you led us right into the Federal Reserve. It's been a challenging time for them. We have inflation soaring. I'm sure you all feel the gas prices if you've tried to fill up this last week. So Rob, how do we think about the Federal Reserve and the pivot they're about ready to make?
You know, we believe there's two factors that really drive long-term equity markets, and that's the Federal Reserve and corporate profits. Geopolitical events create a lot of anxiety, but they tend to be shorter term in nature. And now we're seeing a big pivot by the Fed to raise rates and to let their balance sheet roll off. And historically, that has been a tougher environment for equities. When we started the year, expectations were for 3 to 4 rate hikes. Now we're looking for 5 to 6. And there's a couple economists out there with 7 rate hikes now. So the Fed has a difficult challenge ahead of them as they try to tame inflation without interrupting the economic expansion.
So obviously a challenge for the Fed, and that's created some uncertainty in the equity markets. Now, one of the bright spots over the last 12 months, and we think will be relatively good going forward, is corporate earnings. And we're just finishing up the fourth quarter corporate earnings. So why don't we talk about that and what that looks like for 2022?
Yeah, Paul, we just finished a great quarter of earnings. And again, it highlights just the profitability and cash flow generation of corporate America. Fourth quarter earnings were up 30%. That's versus expectations of 21%. 76% of companies in the S&P 500 exceeded analyst expectations. That's versus the one-year average of 83%, so slightly lower, but still very, very respectable. Now, there were a couple companies that did guide for softer guidance going forward. One of them is Facebook, now called Meta, and Netflix, PayPal. These were pandemic winners. And now that the economy has reopened, they're seeing slower sales and earnings growth going forward. Again, one other theme that really played out during the quarter was discussion about peak operating margins. And on this graph here, you can see some commentary from executives as they talk about the challenges of these escalating costs, really around energy, materials, labor, and also freight and transportation costs. With that said, though, we still expect to see relatively strong earnings for 2022 of around 9%. And those are pretty good numbers when you compare those to the prior year numbers, which were very strong.
Obviously a great 2021 for corporate profitability, record highs as far as corporate earnings go. And we generally have to remind ourselves and investors that corporate profits have been very good, and even in a rising rate environment that the Fed is going to be pivoting to, stock prices can still go up. Obviously, Rob, myself, the investment team continue to monitor this, make the changes to portfolios that need to be made, and as always, thank you for the opportunity to work with you and your family, and have a great day.